Wizz Air jumped 10% last week after Q3 results. Most people think they missed it. I think that was just the warm-up. I hold this stock at 5% of my portfolio, and my base case target is £22. Over 50% upside from here. Today I'm going to show you exactly why this is the turnaround play I'm most convicted on. Quick overview for anyone new. Wizz Air is the largest ultra-low-cost carrier in Central and Eastern Europe. 26% market share, 17.5 million passengers last quarter alone. The key structural story: they're transitioning to an all-neo Airbus fleet by 2029. That transformation is the engine behind everything in this thesis. My thesis rests on three catalysts converging right now. First, the fleet inflection. The Pratt and Whitney engine crisis that's been crushing this stock for 2 years is peaking. Grounded aircraft down from 40 to 33 with a clear path to full recovery by end of 2027. Second, the liquidity bridge. 2 billion euros in cash, 500 million bond just repaid from reserves. Solvency risk is dead. And third, the CEE growth engine. Double-digit capacity growth with 90% load factors while competitors are flat. These three things are converging simultaneously. But the market doesn't see it that way. Why is the stock still cheap? Because consensus is stuck in the rearview mirror, fixated on 5.2 billion in net debt, and skeptical on engine compensation. Valid concerns, but they're missing what's actually happening. EBITDA up 12%, 88 aircraft deliveries deferred to prioritize cash generation. The market is pricing legacy distress. I'm pricing normalized future free cash flow. That gap is where the opportunity lives. Revenue hit 1.3 billion euros, up 10%. But the real story is the mix. 46% comes from ancillary services: priority boarding, luggage, seat selection. This high-margin stream means the profit engine keeps running even when ticket prices face pressure from capacity growth. And Wizz is also building entirely new revenue channels. 11 XLR aircraft are entering the fleet. Long-range single-aisle planes capable of 7 to 8-hour missions at ultra-low cost. The London to Saudi routes are already beating expectations. If a route works as an XLR mission, great. If not, they fly it as a regular A321. Optionality without forced bets. But the real competitive edge goes deeper. In airlines, the lowest cost wins. Wizz Air's moat has 4 layers. CEE-based labor at a fraction of Western costs, 90% load factors maximizing every flight, #1 market share creating entry barriers, and the youngest fleet in Europe driving the lowest fuel burn per seat. This cost advantage only widens as the neo transition completes. And management is weaponizing it. They're closing underperforming bases, Vienna, Abu Dhabi, and redeploying every aircraft into CEE and Italian strongholds. Summer capacity is up 24% on ASKs and 30% on seats. Critically, almost none of that comes from new planes. It's unparking grounded aircraft and squeezing more productivity from the existing fleet. Very different risk profile, and the demand confirms it. 17.5 million passengers, up 12.5%. Load factors holding at 90%, even with 33 aircraft still grounded. The structural demand for low-cost travel in CEE is undeniable. But if demand is this strong, why is Wizz still losing money? Because the headline loss is misleading. Net loss of 139 million. Yes. But that's down 42% year-on-year. EBITDA hit 176 million, up 12%. The gap? 300 million in depreciation from accelerated fleet returns. A temporary transition cost that peaks over the next 2 years, then falls away. The operating leverage is clearly emerging. The unit economics confirm it. Ex-fuel CASK held at 2.94 euro cents, up just 2.1%. Despite inflation, despite returning 18 aircraft this year, they're holding non-fuel costs flat through the most disruptive period in their history. Once transition costs roll off, this cost advantage becomes unmistakable, and the balance sheet supports the whole thesis. 2 billion euros in cash, liquidity ratio at 34%, among the highest in European aviation. The 500 million bond, repaid from cash in January. Net debt is $5.2 billion, but it's mostly aircraft leases, not financial distress. The runway to complete this transition is secured, and management is extending it. The fleet reset defers 88 deliveries beyond fiscal 2030, cutting near-term capex dramatically. Free cash flow was neutral this quarter, expected to turn positive going forward. This is the pivot point, yet from surviving the crisis to creating shareholder value. Now let me put a price on it. My DCF uses conservative inputs. 10.5% WACC reflecting leverage risk, 2% terminal growth, 15% tax rate, and EBITDA margins recovering to 20% by fiscal 2028. Just back to pre-COVID levels. Fleet growing at 6.9% through fiscal 2030. So what does the model say? Intrinsic value, £24.50, 72% upside. Even under stress, WACC at 11.5, terminal growth at 1.5, the stock comes out around £19. I cannot find reasonable assumptions that justify the current price unless you assume permanent impairment. The comps tell the same story. Ryanair trades at 8 times forward EBITDA, EasyJet at 6. Wizz at 4.5. As the engine overhang fades and the balance sheet improves, even a re-rating to just 6 times, still below Ryanair, implies major upside. But let me be straight about the risks. Bear case, £8. What breaks? 3 things at once. Oil above $90 sustained, GTF problems worsening, and a CEE recession killing travel demand. Net debt to EBITDA above 5 times, potential equity dilution. That's why this is 5% of my portfolio, not 20. But the probability-weighted return is heavily asymmetric, and here's what tips the scale. Ukraine. Before the war, Wizz had 10% of that market. With the Russian carriers and UIA gone, they're targeting 32% post-Reconstruction. The plan is ready. 30 routes within 6 weeks of a ceasefire, scaling to 150 routes and 15 million passengers by year 3. 8 million displaced Ukrainians plus decade-long reconstruction labor flows. Management was in Kyiv last year, infrastructure intact, regulators ready. If this materializes alongside full fleet recovery, £29 is realistic. That's a double from here. Bottom line, engine crisis fading, balance sheet stabilizing, operating model proven. Base case £22, DCF says £24.50, Ukraine takes it to £29. Bear case £8 in a scenario I consider unlikely. The risk-reward is asymmetric and I'm staying long. Subscribe for the next deep dive. I'll see you in the next one.